This is Team 4, and we'll be going over video 1 based on the Eastern European region with the Czech Republic, Hungary, Romania, Russia, and the Ukraine. These 5 countries of the former Soviet bloc in Eastern Europe offer, together or separately, promising if challenging markets. Russia, Hungary, Romania, Ukraine, and Czech Republic, sometimes known as Czechia, present new markets as alternatives to the well-trod Western Europe. Additionally, they may be more culturally approachable to American concerns compared to nations in Asia, the Middle East, and developing areas of sub-Saharan Africa. While these countries are still emerging from their decades of planned economies in the orbit of the Soviet Union and communism, they have developed physical and communication infrastructures, generally well-educated workforces, a consumer class with steady if slowly growing disposable incomes, an openness to modern advertising and promotional techniques, and varying but generally ample internet usage. Challenges include myriad levels of taxation on foreign companies, various forms of corruption, and in some instances, particularly Hungary, a growing militant nationalism that could prove problematic to international marketers if not handled with care. Now that we have a general understanding of these countries in this region, we now want to focus our attention on the country's backgrounds. Specifically, for each country, we want to identify the population, the percentage of the population in urban areas, and the median age of these populations. So with the exception of Russia, which is the 9th largest populated country in the world, Eastern European countries tend to have slowly aging, smaller populations. One interesting statistic of relevance is Romania only has 11% of its total population situated in urban areas. The other 4 countries have at least 70% in terms of trade. Each country within the former Soviet bloc generally exports large supplies of machinery and equipment along with raw materials and oil. Top imports as well include vehicles, medicine, and other machinery. But outside of the region, Germany and China are its top trading partners. Although the United States isn't a major trading partner with Eastern Europe countries, there is still an exchange of various metals, both natural and synthetic resources. So according to the Global Competitiveness Index, these 5 countries all rank between the 30th and 70th range in the world. These rankings take into account various factors such as infrastructure, population, and market efficiency. So the overall economic conditions across the 5 countries are diverse with upside potential. The Czech Republic appears to have the best economy among the 5 with a GDP per capita value of 21,707 and GDP purchasing power parity value of 31,072. So although these values pale in comparison with the Western Europe powerhouses such as Norway and Switzerland, it is still promising to see the continuous GDP growth since the 1990s. On the other end of the spectrum, Ukraine's GDP per capita values are significantly lower than the rest of the bunch. This is likely a major symptom of continuous political unrest, largely perpetrated by the Russian annexation of Crimea in 2014. Furthermore, unemployment is at 8.9% and inflation at 14.1%, which are alarmingly high rates, and the government debt as a percentage of GDP is at 79%, which suggests that the Ukraine has a long way to go in terms of economic recovery. Now, Russia, Hungary, and Romania all are showing signs of growth, with a 6.9% annual GDP growth for Romania, for instance. However, the GINI indexes for each country within the bloc shows signs of economic equality, which is not surprising considering the era of planned Soviet bloc economies only ended less than 30 years ago. So one interesting thing to note is Russia's GINI index is at 41.2, which is much closer to that of the United States, which is at 45. But compared to the rest of the countries, all of them are lower than 30. With a significantly larger population in Russia, any marketing approaches would have to be adjusted accordingly for each of these classes. At least half of each of these countries' entire population can speak English, at least as a second language, which is a promising sign for potential U.S. companies wishing to expand in this region. And according to the Hofstede Insight dimensions, all 5 countries score extremely high in the uncertainty avoidance dimension and extremely low in the indulgence dimension. This suggests the culture is generally cynical and wary of uncertainty, which is somewhat expected given the power struggles with the Soviet Union. Another prominent feature within the region is the glut of rules and regulations imposed by each country's government. For instance, the Russian government controls a majority of the country's media, and ties to the Kremlin can be seen throughout many facets of its economy. In conclusion, these countries' economies are in recovery mode, which should influence future U.S. business and marketing opportunities in this region. From an economic perspective, Hungary and the Czech Republic should present promising countries to invest in for the U.S. In particular, Hungary already features several American advertising companies such as McCann Erickson and its capital city Budapest, which is in the center of a strong economic activity, while embracing many different cultures. Russia is also an interesting case, since its massive population size will always offer tantalizing upside for foreign companies considering an investment, especially in the infrastructure industry. In fact, today there are nearly 3,000 American companies operating in Russia, which mostly include big-name brands such as PepsiCo and Visa. The biggest roadblock and risk to investing in Russia remains the numerous regulations imposed by its government, which has a hand in nearly all aspects of civilian life and has also had rumors of corruption. So this concludes video 1 for Team 4.